Lots happening in the commodity world between gold, silver, oil. A lot of these things have seen pretty big pullbacks. One thing found interesting, though, is the energy sector has held up really well, which is interesting. Something we could talk about a little bit more with our analysts. We have Kevin here and Sam. But basically, going through a bunch of things today, we're going to talk about natural gas, we're going to talk about crude oil, we're going to talk about gold. And if you guys have any questions, feel free to write in the comments. Let us know. We're always happy to answer your questions. And definitely, if you guys are on YouTube, hit that notification bell. Hitting that notification bell makes sure these things pop to the top of your list so you can see all of our videos. If you're just a subscriber, YouTube has changed it now. So if you're just a subscriber, it doesn't send it to you immediately. So definitely try to hit your notification bell to see these videos. And we are on Twitter, YouTube, and we do a podcast on my Substack as well. My name is Jason. This is the Commodity Report. So, Kevin, you were mentioning natural gas today, and we were talking about this a little bit already. So, what do you think about natural gas? Any ideas where you think natural gas is headed? What people should be doing, buying, selling? I know a lot of our followers definitely love to talk natural gas.
Yeah. It's had a nice little pop here to the upside, actually, if you're kind of looking at it. So I think a couple of things are happening. So we had a winter event over the weekend here out in Colorado. I think we got our first like pseudo blizzard. So I think we're seeing the preparation of the weather premium being put into the contract. And then also on the other side of that, we have a situation where we also have like rolling of contracts. So I think you'll see that when these contracts are coming to an end, you'll see a lot of those short sellers in the market starting to buy those contracts back, right? And then they'll start layering in their shorts for the next contract, which is going to be DEES. DEES is going to be the real big focus for right now. And then we'll move over to the Jan and contract and things of that nature. But I think one, it's weather premium. Two, I think it's also the election as well. So the thought process is that liquefied natural gas, there's going to be a lot more money that's being put in, right? So as far as infrastructure and the expansion of liquefied natural gas will actually provide a premium for the gaseous form because we'll have something else to be able to do with it. Now, LNG has actually been a product that we've talked about for a fair amount of time here, and that longer term trend of regasification infrastructure that's going to be needed for it. The restructuring when it comes to geopolitical and supply lines that are out there is also another tailwind. So I think that's another reason why you're seeing a little bit of that premium. That Trump trade should be a little bit more favorable for natural gas. There's also kind of looking at the expansion of pipelines as well, and what that could do to infrastructure spend from a lot of these companies. So I think those are kind of the two areas. Now, what I will say is if you look at a chart of it, and you can look at a daily chart, we're hitting an upper end of a resistance zone. We've been in this down descending type of channel line basically since October of last year. And so we're touching the upper end of that line. Now, one thing to kind of note, we are making higher lows on natural gas. So the technicals are telling you that it's either breaking up or it's going to break down. It's either going to remain in its channel, which right now it's the area of resistance sitting at around $2.94. Do we see a pullback? That pullback could come down to around $2.40 here. And the lower end of that channel line, if you're looking at it, is going to be around $2.10. Or do we see a fundamental breakout to the upside? And you can make a case for both. I think we do have some favorability when it comes to the latter half of this year going into next year because of just the seasonality effect, taking out the LNG side. And I would not be surprised if we actually do kind of eventually between now and March, I would not be surprised if you actually hit 350 on Natty. I'm not sure if it's going to be sustainable to hold at those levels, but at least 350 on Natty. So a decent run up today, up over 10% right now in the session. And I just made a joke, and I'll kick it back. I made a joke because everybody and their mother is following this crypto stuff, right? Bitcoin, this, that, and the other. And we always kind of have to go, and I'm not hating on it, right? Make your money. But the thing that I kind of find funny, one of them is a market that you can make a case for. And yes, there's going to be some tailwinds, and maybe there's going to be a reserve and all this stuff. But there's a lot riding on the new administration to do exactly what they said during the campaign. And anything that goes off without a hit, like anything that messes that up, obviously could cause a little bit of reversal when it comes to crypto. But you look at the other side of that, natural gas has actually outperformed. I don't know where it's up right now, but since we talked about it, a week ago, 2 weeks ago, Natty's up like 26%, 27%. So there's always going to be some outperformance somewhere, and you don't have to always follow the hot topic that's in that space. Just kind of do your due diligence and find areas of opportunity. And I think that's what Natty's doing right now. Once again, one more pullback could be in the cards. This is not a recommendation. We were talking about this on offline. This is not a recommendation. If you're going on past trends right now, do you want to take a gamble on the breakout? I would probably be a little bit more reserved. If you're going to get that breakout, it's going to be in the next couple of days before you start getting institutions starting to layer on their shorts again, trying to push this down. So the fundamental case is still kind of like bearish structurally, but it's a nice little win for right now. Risk reward, you probably could take a downside swipe, looking at maybe some put options, especially if you're looking at the put contracts. They're not that expensive on a relative basis. If you do think there's going to be a pullback. There is some bullish activity, though, with somebody buying the 330 calls on Natty that expire in around 15 days from now. So that's something that I haven't seen in the past that we have seen right now. So I'll kick it back over to you guys. What do you guys think about it?
No, and I love that. So I brought this chart up from Sam. So my chart that I posted on natural gas was a little bit more longer term. Sam had a shorter term one, but he also had these volume shelves. And I love these volume shelves, Sam. I'm glad you put these on so many of these charts, because basically for futures, we're talking about open interest. When you get over these open interest levels, this is where you usually see major moves happen. And what Sam has here, well, you know what, Sam? You explain it. It's your chart. You go ahead and explain this chart, because it's a great chart. I'm getting too excited.
Reading it from left to right, that peak in 2022 when we had this Russia situation and all of these energy products were going crazy. We had a nice failed breakout there. So I anchored a VWAP to that level, and it has been a perfect level to sell natural gas over the last few years. It's just been a big, messy basing pattern. But I think if natural gas can get above $3, it has a chance to get back to that former high. And that sounds kind of crazy, like natural gas coming from $3 back towards 10. But I think that's in the cards. I think we have not seen the real move yet from natural gas.
No, I agree with that. I don't think we've seen the real move from natural gas by any means. I definitely think that too many people kind of look at it and go, well, natural gas, it's the widowmaker trade, it's dead money, it's this and that. And it's really like what Kevin said is important. Now, once again, I'm long Bitcoin, full disclosure. I'm also long gold. I'm also long natural gas. So full disclosure on all those things. But what Kevin said is perfect, which is it doesn't matter what you trade. Like, look, this is a thing that I've thought about a lot lately. And Sam, Kevin, you guys can add on this if you guys want to. But people talk about being technical traders, and they're like, I'm a technician. I'm like, oh, that's great. You know, you look at price. So do I. So you're buying the breakout in natural gas. Let's say it gets over this level. Oh, no, I don't trade natural gas. Well, why don't you trade natural gas? Well, I don't understand it. And then you get to other things. Well, I don't understand commodities. And I don't really, to me, the answer is if you're a technician, you should be able to trade everything. It's all the exact same thing. We're looking at price levels. You're getting over this price level, it's worth a buy and a shot at it. You can make a lot of money in Bitcoin. You can make a lot of money in natural gas. You can make a lot of money in gold. You just have to know how to trade it. So that was something I thought about too. And Kevin, I also wanted to point out, because a lot of people always come on here and they wonder about, like, you know, how many times have we gotten things right? How much do we talk about certain things? Like, you guys can all go back. We have this all on a playlist. So if you guys want to go back, check what Kevin and I are talking about, please do. There's tons of stuff on there, tons of good information, all under the commodity report in our playlist on YouTube. But this was one that we were talking about, Kevin. So Kevin talked about natural gas last week, and literally we had a skyrocket where natural gas went nuts after that. And then a while ago, we were talking about this one, Kevin. Remember, we were talking about the band squeeze breakout and LNG and the fact that you were talking about buying it and the reasons why. And so, like, you know, we really try to be objective here when we're right or wrong. You know, when we're wrong, like, there's not a problem getting on and saying, hey, I got a call wrong. That's going to happen. But there's been a lot of really good calls in the commodity space lately on here. So I really have to shout out to Kevin for a lot of these really great commodity calls, especially when it comes to natural gas, LNG, these areas that a lot of people don't really trade much. So anyways, getting into what's next. So what are you guys thinking what's next for these markets? If somebody wanted to buy LNG today, would you say that's worth a buy, or do you think that's a little bit too extended?
Well,
Kevin, why don't you talk about it from a fundamental side, and then
yeah,
Sam can talk to the chart.
yeah. So I just want to clarify something. I always talk about risk reward setups. I never talk about buying or selling anything. Full disclosure. But I know what you meant. I just had to provide that little disclaimer. But when you're looking at this, so this is Cheniere Energy, ticker symbol LNG. And there's other ones that are out there. There's LNG, and all that stuff. I mean, this is one of the bigger players. Actually, I believe they are the biggest publicly traded company that has exposure, pure exposure. And this company really kind of they export LNG and they basically utilize long-term derivatives contracts to lock in prices. So this is not a company that's out there like trying to just sling LNG whenever like somebody needs it. They are actually very prudent when it comes to their models. If you're looking at the valuation, it is a little bit rich, but it was very, very cheap like 6 months ago, 7 months ago. But I think the theme when it comes to the expansion of liquefied natural gas and our ability to be able to export that and utilize that as a geopolitical lever, I think is something that's really understated. And there's other companies out there that have exposure. Chevron has exposure. Exxon has exposure, but not pure exposure plays like Cheniere or even like a Shell. Royal Dutch Shell is actually one of the bigger players at LNG in Europe. So fundamentally, I think there's still a narrative. There's still a secular play that's here. The stock doesn't get a lot of attention from the street. And the options, they trade kind of wide, but it's been in a nice little trend to the upside here. We are seeing a nice little breakout over the last couple of trading sessions. Let's see how long it's going to be able to last here. But this has been something that's been on the radar for us for a fairly long time here, and now it's definitely resolving itself.
From the chart, I just see a massive consolidation being resolved. Like LNG has gone absolutely nowhere for over 2 years, and it's just now breaking out to new all-time highs. So I think this is just the beginning of a bigger move. I think this one has 300 written all over it. I think it could happen fast too. Like the trend leading into this consolidation was massively up. It rallied like 600% in a year, really 2 years, but LNG can move. If you go back to 2002 to 2006, that was a great time to be in commodities. LNG rallied over 11,000%. So this one has a track record of rallying straight up for years at a time. So,
yeah. How quickly can we make charts? Like, say, if I threw you something, are you able to like
whatever you need? What do you need?
Okay, so like while you're building this out, so let's look at a natural gas because you kind of talked about the cycle, and Jason and I brought up this chart last week or the week before. Where you look at a monthly chart of natural gas /NG or whatever you have on your platform, and then put the MACD on it. You can look at an RSI as well. You know me. When I look at MACDs and I look at some of these technicals, when you go on a longer time frame, I feel like they have a lot more staying power or truth to them, if you will. And that's where you can kind of make that case. Well, maybe natural gas is actually starting the cycle, its own cycle right now. Now that cycle can maybe only last for a year, maybe it lasts for 2 years or what have you. But the technicals do kind of align that says natural gas can run. The thing that you have though with natural gas that I don't know, and I feel like it's a curveball right now, is like you need that geopolitical premium in order to kind of get that spark going. And that's what we saw the last time. That $10 move, it wasn't just because like demand was completely rampant and everybody was just like consuming 2x, 3x. We had a logistics issue that was taking place. We had the start of the Russia-Ukraine conflict. So that really kind of pushed it to the upside there in the fashion that it did. And so what is going to be that catalyst now? If you kind of think about it, you're in a regime, or we might be in a new administration. I don't want to call it a regime. You're in a new administration now that actually is trying to, based on their rhetoric, dampen the Russia-Ukraine conflict, right? Trying to make concessions, maybe try to find some middle ground there. That really doesn't provide you that geopolitical risk premium to kind of put this up and put that upward pressure to it. I'm not knocking the thesis because once again, I look at technicals too. And if you go back, you got it up there right there at the bottom. How many times have we seen a MACD cross below the zero line and what happens with natural gas? It may not look like a lot on that chart, but when we talk about trading, it's all about percentage gains, right? It's not about the actual dollar value of the move. If something's trading at $1.80 and it moves up to 360, that's 100%, right? Like that's a banger right there. So we can't just look at the notational or nominal value and say, man, there's not really a trade there. Those peaks to troughs, when you're looking at those MACD crosses, are still actually very remarkable, right? Even if we're talking about the move over the last couple of weeks, I mean, we got down to what, $1.98, $1.90, $1.86 this year. I mean, even from there to where we're at right now is a remarkable move. So just keep that on your radar.
So
once again,
natural gas going
of,
from $3 to like $10 really isn't that crazy. It's just,
I mean, it's
a little
tough.
bit more than 2x.
You're going to need to have something
in
else.
that context, in that percentage term context.
Yeah, but I think you're going to need to have something else for it to get to $10.
Sure.
You know what I'm saying?
I don't know what that catalyst is, but I see the setup, and like I love that you brought up that long-term momentum, like that monthly MACD or monthly PPO. You know that the bottoming process is going to be messy. If you study history, it's been messy every single time down here. But you know that the odds are you get a trend reversal, and you want to be long for that.
Yeah, I would say tactically, probably, I don't know. Me, tactically, if you're looking at this for the next couple of trading sessions, maybe sit back, relax a tad bit here, but a fade would not be outside of the norm for this right now. Perhaps that actually coming back down around 280.
Yeah, like as long as it's below 3, in my opinion, it's sideways to lower. It's just a messy base. It's really messy short term. But above 3, let's go. Let's get LNG calls.
All right.
I agree with it. Honestly, I highlighted on here these moves that Kevin was talking about, some from peak to trough or trough to peak, basically. We're looking at 131%, 130%. The big one that happened in 2020, you're talking, 477%. And just the recent one that I'm not even drawing all the way from the low, I'm drawing the recent move is 45%. These are huge moves that happen very quickly in this market. And what Kevin is talking about is very important because, when you look at Bitcoin, for example, everybody's going to get excited. It's going to hit $100,000. That's not a huge move anymore. When the old bubble, and I wrote about the experience I had with trading this old bubble. I'll put a link in the comments if you guys are interested. But the first bubble in Bitcoin, which was the 2016, 2017 bubble, you're talking like some of the craziest moves you'll ever see in your entire life. And these are from, dollars or $100 all the way to $20,000. Bitcoin now moving from 80,000 to 100,000, that isn't a huge move. So once again, looking at these other areas, like a move from $2.50 all the way to $5 in natural gas is a much bigger move.
Yeah, and if you look at, sorry, yeah.
No, go ahead, Kevin.
Yeah, look at it like notation. So every penny that you're talking about for natural gas is $100. Okay?
Yes.
So it sounds like a small move, but like we've moved 27 and a half cents, give or take. I mean, you're talking about $2,700 move just today alone for one contract. And if you're trading the options on them, put side options right now at the money going for around 17 cents, give or take, that's $1,700, right? When we're talking about going from $3 to $5 or to $10, sorry, my son thing going off, what have you, you got to look at it from a per contract basis. That's a boatload of money, a boatload. So I think that's always really good for us to be able to have that context as well. A 10-cent move, you're talking about some cheddar there. It's not outside of the realm of, and then for this, it's a high vol. I mean, this is probably the most volatile, I would say this is the most volatile, actively traded and normalized contract, if people can understand. No one trades softs outside the nerds like yourself and mine. No one trades softs, right? We
But
may
even
get a
natural
couple of
gas would be more volatile than most of the softs even. Like
yeah.
I can't even think of a soft where this is underwhelming in comparison. Like
I would say lumber.
no,
Lumber
I would say
probably.
natural gas moves it. Well, I know the volatility to my stop is wider on natural gas than it is on lumber. So that's, I mean, it's one of it. You're right. It is the most volatile asset in history. Bitcoin only outpaces it a little bit more because it was been so small. But if we're talking about things that are traded into billions and billions of dollars, it is the most volatile asset in history. And so there's a lot of money to be made in these moves. So I love that Kevin brought up that idea because so many people are interested in the futures markets, but so many people at the same time, after being interested in the futures markets, they don't understand like how we make money, for example. They don't understand how big some of these moves are. When you're talking about a very small move, like something like you know, uh, we're talking about bonds, for example, short dated bonds. These are huge contracts. People think of them, they look at the SHI ETF and they go, oh, wow, it moved 0.2%. Who cares? Really, when you're looking at these bond contracts, you're talking about $100,000 per. The margin's very low. You can easily, for a $100,000 account, you can get $1 million worth of contracts in bonds pretty easily. So there's huge moves to be made in the futures market. I just wish more people understood the futures market.
So we started this at what 11? What time did we start this? 30 minutes ago, right? 11:30.
Yeah, 130.
The LNG thing is already up another buck. I mean, it's crazy to see some of these opportunities in this market here. You guys want to talk about gold real quick? Because I'm gonna probably make some people upset here. But gold's making a technical pullback. If you're kind of looking at the weekly chart, I had it up yesterday. I would look at that 20 period moving average on the weekly as your area support. We're actually getting kind of close to it. 2570, 2580. You're seeing vol kind of drop to the downside, right? The dynamics may have shifted here a little bit. Maybe the concern about the uncertainty of political unrest kind of being pulled out of this market. If you're looking at silver, if you're looking at gold, you also have kind of the situation happening in China too. So China's not really like meeting the streets expectations when it comes to stimulus. I'm not trying to call a top. I think the top probably has already, like the near term top has already happened. I mean, you have a shooting star, a pattern that has kind of taken place, or candle that took place on the weekly chart 2 weeks ago. Now you're starting to see a little bit of selling here. Looking for a pullback coming down to 2580. Maybe a rebound once the inflation data comes out on Wednesday. Inflation may actually come in pretty hot for CPI. The swaps market is pricing in something that's coming in pretty hot. I think the market expectations right now is sitting at around 0.3% month over month. But the swaps market is actually pricing in and actually a reacceleration for this print. And if that were to be the case, then you probably would see maybe a technical bounce to the upside for gold. But I feel like we are starting to see the rotation out of that trade, at least for now. Looking at another, once again, let's say $50, give or take, 50, 60 bucks left to go to the downside for this before maybe some new buyers come in and try to bring it back up. What do you guys think?
I sent Jason a chart. I totally agree with you, Kevin. Gold is hitting its second Fibonacci extension level since it resolved higher earlier this year in March. At the first extension level, gold consolidated there for like 16 weeks. It was a long time of just chop. So I would not at all be surprised to see some type of consolidation like we saw several months ago. Just a couple months, maybe longer, maybe shorter, who knows? But I think sideways is the path of least resistance here for gold. 2750 is my line in the sand. If you get back above there, I think it's going higher above 3,000. This could be the last consolidation before we see gold 3,000.
Yeah, and I do agree with Sam on that one too. It's just once again, this is a big trend, and gold, when it trends, it really trends. But once again, when Sam and I just talked about this earlier today, which was we don't want to see gold just rip straight to like 3,000, 4,000 all at once. We want to see it consolidate. Too many people get too excited and they think things are just going to go on forever and ever and always be exactly the same. But really, we're looking for this big move to happen in small spurts. Look at this chart of gold, for example. This is a beautiful trend. We had that move up from the bottom that happened in 2023, and then it consolidated. Then we broke out to the upside. That is a grade A breakout. What that means to me and how I explain breakouts is I grade them. So grade A just basically means it's a really nice consolidation. It's over a long-term period of time. And before we even broke out, we consolidated right under that resistance. Then we break out higher to the next move. Now we get up to here. Now we're above 2,300. We're consolidating. We threw another flag, and then we make another move. I mean, this thing is textbook trending beautifully, really. Like if you're a long-term investor, long-term trader, it's a great trend. If you're a short-term trader, there's great targets to hit. Sam has marked out these targets beautifully. You can basically hit these targets, take some profits, or take the position off, wait for a new high of over that 27 level that Sam has marked off. So I personally think there's a lot of interesting things in gold here, and I think it's perfectly normal to see this pullback that's happened. I think too many people are going, "Oh my gosh, it's the end of gold. It's the end of everything. The election has happened. Now we'll never need gold ever again." And really, it's a euphoria has happened. Gold looks like it's kind of high. Investors could think, "Hey, I could deploy my money elsewhere." Now that I'm more bullish on the economy, now that the election is over, I don't have to just sit into something like gold, which is very safe and safe haven. Now I can get to things that have some more alpha. And I think that's kind of what we're seeing in gold right now. So I agree like with the time frame for everybody, which is at the moment, I would assume consolidation. If we started to break under 2350, I would assume worse. But for now, I just assume consolidation and probably dead money for a little while until we finally get back above those levels.
And Jason, you were talking about grading your breakouts. How important to you is it that gold never retested that breakout level? Once it got above that 2090 level, it never looked back. Like that makes me think about this Bitcoin breakout.
Yeah.
You don't want to see Bitcoin retest that level, right? Like, how important is that to the longer term trend? And
that is a fantastic question that I don't think has ever been asked to me, but I have actually like looked at that. So in reality, if you just back test that, there really isn't much of a difference. Sometimes the only thing I have found through back testing is if you find, and this is very hard to quantify. So once again, and Kevin, you know this before I even say that what I'm about to say, quantifying is really hard. So don't take it as this is a perfectly back tested model. This is just an idea that I tried to mark out and try to figure out, and I think it makes sense. Which is the best thing for breakouts or when they happen when there's no news around it. Gold had a really nice breakout over that level that you're talking about, Sam, because there was no news around it. Nobody cared. Sure, there was things kind of happening under the surface, but it wasn't like on the cover of anything. Bitcoin's one where everybody in the world is looking at it. Everybody was watching that level. At the same time, am I going to take the trade either way? Absolutely. If it pulls back into that zone, all that really means is sometimes it's just not ready. But usually sometimes that second breakout can be even better. So once again, it doesn't really matter for just the breakout, the style of the breakout. What does matter the most and what I've found is that if there's news around it, that usually isn't a good sign. If everybody's paying attention to something, that usually isn't a good sign for a breakout. If nobody cares above a level like 2090 on gold and nobody's even talking about it, most of the time that's something that trends, and it did. It made it all the way to 2700. I mean, that's a huge move for gold, especially as a low volatility product. And remember, Kevin and I were talking about contracts today. These gold is a huge contract. You're talking about over $100,000 contract. A move to 2,700 from 2,000, that's a huge move. That's a lot of money right there. So once again, $27,000 basically. So once again, look at the contracts, look at the sizing, figure out what you're trading and your time frame, and then also I think the story of today, look at other markets. Like, don't be afraid to look at the futures markets or the options markets or some weird country that you've never heard of and try to learn how to trade it. You're going to find a lot of alpha talked about this before. You know, if you go back to 2019 for me, 2019 was a pretty dead year. Yes, the market did okay, and there wasn't anything wrong there, but you had to kind of, if you were picking things, you kind of had to pick and choose wisely. Countries like Greece, though, I had major outperformance to the S&P 500 because I bought Greece. I bought Russia at that time. I bought Brazil. So all of these countries. So mainly what I'm saying is look all over the globe. This is why we talk commodities, because it's macro. It's everything. Everything's all included in all of the trades that we're talking about. If you're talking about gold, we're understanding safe havens, what's going on in the psychology of the market investors. If we're talking about oil, we're understanding sectors, we're understanding yields, we're understanding the energy stocks, obviously, like natural gas. It's another thing. You know, we could go on this, but basically saying understanding commodities is understanding the world, and investing in the world is going to help protect your portfolio.
Great.
So anything else? We got any comments from anybody? Somebody wrote how it was funny about the Widowmaker trade, and I thought that was cool. That is pretty funny. The name, Kevin, have you ever talked to anybody about like why they call it the Widowmaker trade? I mean, I have, but I'd love to hear if you have a story about like anybody who blew up or lost a bunch of money or anything for natural gas.
Yeah, no, I mean it's a very tough contract to be able to trade. The primary trend has been to the downside. And then when every once in a while you get these very strong pops to the upside, right? You get short covering event. And it's just it's very hard to kind of time too. You have the seasonality aspect of it. So if you're not like you're not a big follower of it, I would not probably suggest trading natural gas directly into the futures contract. Try to look for a proxy like a UNG, which is not the best proxy by any stretch of the imagination, but it still kind of gets you exposure, at least until you can kind of figure out how to trade it. But it's a very tough trade. It's kind of like those Sour Patch Kids commercials, right? They're sour and then it's sweet. It's kind of like trading natural gas, but more often than not, it's sour, and it is rarely sweet. But when it's sweet, you kind of feel like you champion that market, and then you double down, and then eventually probably blow up. So it's one of those things that I like looking at the options in them. So like having complete risk defined strategy that's out there, and then you buy time. Like over time, you fade natural gas. If you're trying to time the right pop, it can be very hard. That's where you lose a lot of money. But when it does hit, it hits very strongly. And that's where you can have multi-baggers within Natty. Once again, the chart looks decent. It's just you have to like discount the chart a little bit more than probably any other product that's out there, because the chart's going to be like, I mean, how many times have we seen this cup and handle look like it's going to break up? Just like I mean, I'm looking at 3 of them right now, and I'm zoomed in on my chart. You could call it 4 of them since October of last year. If you're looking at a weekly, where you're like, oh, it tested it, failed, comes back up, test, failed, come back up, test, failed. What's different about this one though is that we are making higher lows respectively. So like eventually we're going to come to the apex of that a descending wedge, and then either you have a breakout or a breakdown. It just depends on, is this the time? And that's the hardest part about trading natural gas, is no one ever knows when it's the right time. You just have to be kind of a little bit lucky and buy a little bit of time and have a little bit of patience for the trade to be able to work out. But yeah, there's a lot of people that blow up on this one. Even myself, like I've had banger trades with natural gas, like talking like 2x, 3x overnight on futures options, which is like phenomenal if you trade futures options, right? And then I've had weeks where it's just like it just continues to trend downward, and you're like, all right, well, this is going to be the bottom, and it's not the bottom. It's just it's a tough contract.
It is a very tough contract to trade. So then we did get another question, which is, we didn't talk about softs. We didn't talk about wheat. The question came in, what about softs? What about wheat? So, Kevin, do you have any thoughts on softs, wheat? Anything we should be paying attention to? Wheat did come down and went past a major level today, but it did get bought up right under that major level.
Yeah, so wheat has like one, obviously we're actually in like a planting season right now. When you're looking at the quality of the crop, I got to look at the updated numbers, but last week's quality wasn't that great compared to what we've seen in the past. And it actually still isn't that great if you're looking at winter wheat. Looks like if you're looking at it from good to excellent, we saw a nice little bump. We're at 41%. Last year at this time, we were at 50% for good to excellent quality. 10-year average right now, we would be at 50%. So the quality hasn't been that great. And there's two ways to kind of think about that. Some people say, hey, well, if it's bad quality, then there should be a premium in some respects. Other side of that is like, you got bad quality, you can't sell for as much, right? And so there's going to be some downward pressure there. You have some weather events too that's kind of taking hold. I also look at the Russia-Ukraine conflict. I'm going to continue to bring that up because I don't feel like people understand that in the next 90 days, things can dramatically change when it comes to the grain markets, and it could be bearish, unfortunately. Actually, it's fortunate if we have a geopolitical risk that's taken off the table. So that's like fortunate, depends on what type of risk it is, but that could be bearish when it comes to prices. So I'm being mindful of that. Trend is to the downside right now. There's nothing fundamentally out there, in my opinion, that says any of the grains outside of maybe corn are really strong buys right now. We just have to kind of let this dust settle, and you have to wait until the dynamics really just change or really shift. Corn does look constructive. Export demand actually is going up. Do you take a shot here? Risk reward, you got to make that decision yourself. And then what contract do you trade? Things of that nature. But not looking too great for wheat right now.
Yeah, wheat was the first one to actually look pretty good, and then it gave most of that back. Now corn's looking pretty good. My own thoughts on it as we get closer. I mean, my thesis all year long has been nearly the same, which is we need to get through the election. A lot of these ranges are going to resolve one way or the other after the election. But the one thing that's interesting, and Sam, you could speak to this as well, is I have seen live cattle kind of give back some of its gains recently. And so something that Sam and I have talked about a bunch, which is the correlation between cattle and corn. So if you're a trader and you're a futures trader and you want to really learn a couple products, understand live cattle, understand corn, soybean meal. Basically, it's the feed for animals. So corn is feed for animals, so is soybean meal. So as you have that feed, if there is less cattle, meaning more the cattle prices continue to move higher, then we don't have the same need for feed. So once again, these products are usually very, very correlated with each other, meaning if live cattle moves higher, or sorry, uncorrelated with each other. If live cattle moves higher, corn usually moves lower. And same with if live cattle moves higher, soybean meal usually moves lower. So looking at those things, I'm kind of getting a little bit more bullish on corn. I've been kind of like, oh, corn is the one that I would like to see move, but it just hasn't really given me many signals yet. We are long corn at the moment. So I do think that there's probably some more upside in corn. Do I know exactly where it ends up? Absolutely not. But I think towards the year end, we usually see these pops towards November, December, even into January. So if we're going to get a trend in corn, it's going to probably happen now. And most of the time, most of the grains fall. A lot of people have been asking about soybeans. I wouldn't touch soybeans. The chart looks terrible. I can't make a fundamental case for it if I wanted to, even if there was a gun to my head. So soybeans, I wouldn't do it. Corn is the one that I'd say be interested in. And then wheat, if it breaks above some major levels, could be signaling that could go higher as well. Sam, do you have any charts or anything you want to look at in the grains or anything?
Yeah, I don't have any charts. I agree with everything you're saying. These markets are really difficult for me to get a read on right now. Like what you're talking about, those relationships between the feed and the cattle. And both of them just look range bound to me. So right now, it's really difficult for me to take either side of this trade. I want to see a resolution on either side. Like I would buy cattle on a breakout, and I would also sell cattle on a breakdown, and vice versa for grains.
Yeah, at the
I
moment
don't really
we're
have a
even
whole lot
still
to
long.
add on this.
Yeah, at the moment we're even still long the feeders. We're long the feeders. I'm not against it at all. I am just saying that if that relationship does break down, that's definitely going to give a boost to the things Kevin and I have been talking about for a while, because there is a story there. There is a fundamental story for most of these things, but really for me, I need the price to also back up my story. Whatever's in my head, the market needs to prove it to me that I'm right, and then I would be more apt to follow it.
Me too.
So
And what do you
yeah.
think about cattle and that correlation to yields? Because that is also a piece of the puzzle that has me kind of stumped. Like
It's a good one for Kevin.
if yields are going to be in a long-term uptrend, like me, I want to bet on higher prices over longer time frames for cattle, and that relationship remaining in place. I'm not sure if you can do like an overlay, but if you overlay live cattle with something like the
I never
10-year
do
yield,
yields on a trend spider, so I'm not sure if I can pull it up, but I'll try to pull it up. Go ahead, guys. I'll work on it while you guys talk about it. Kevin, do you have any thoughts on that?
yeah. Do you think there's a reason for that, Kevin? Is it just coincident and I'm seeing things on my charts?
No, I don't. I
Could be
mean,
I don't know.
look, some of the some of the best trading indicators are found by accident, right? Some of the best correlations are found by accident. Now, there's a correlation and then there's causation, right? And then you have to go back and be able to be to test that out. In my head, I don't think there's a direct correlation, but you can make the case. You can make the case, okay, interest rates moving up, markets pricing in better economic data, not only just here in the United States, but globally. If that's going to be the case, and if it's the China story, you're going to have greater consumption. China is a big importer of our beef, pork, corn, and soybeans. Those are the four big imports from China. So maybe there's a correlation there. If the market thinks that we have really good economic data, and we do have economic data that's really strong, then you have that, you have that global expansionary story, and then vice versa. The cattle thing, though, is more, I feel like cattle is more structured in nature, and for people to kind of really understand what has actually occurred. Since COVID-19, a lot of ranchers have not expanded the population of cows and beef. Like they actually have constrained it because it's been really difficult, because of feed cost is very difficult, as well as water too. People don't really realize that if you come out to like where I'm at right now, like water rights, like people will literally go to war and draw guns over water, especially in the southern half of Colorado. Like it's a really big deal. So there's two ways that you can resolve that as a rancher, right? Especially if you have a collective. And a lot of these guys, if you go to like auctions, which I would recommend somebody like go to an auction if you can. A lot of times they're just at your county fairgrounds, and you would be surprised. Sometimes you can actually see auctions in like the middle of, in the heart of cities too. But they're really fun and interesting. If you know about this culture and the rancher culture, they do actually have a little bit more of a collective. Think of them as like a union type of situation, right? There's two ways that they can actually expand their margins or even preserve their margins. They could either ramp up the amount of cattle in production, right? They can have a lot of cattle, and they can also pack the weight of that cattle, right? More weight, more meat you can sell. Or you can constrain supply, right? And if I have less amount of cattle that's on my ranch, it's less cost for me to be able to maintain, less water for me to be able to have to provide. And then once again, you're taking supply out of the marketplace, you're driving up prices. That's literally all that's been taking place over the last 2 years, 3 years. So that's more structural in nature. You can also see that correlation with cattle weights. And Jason, I know I sent this to you a couple of weeks ago. I haven't updated one, but I do have to jet here in about 5 minutes. Maybe we can bring that old one up. If you kind of notice this year that's different, is that weights are smashing trends to the upside. I mean, to the tune of 50, 75, almost even 100 pounds in some cases. If you're looking at the 5-year average, and you're looking at this time last year. So once again, you focus more on quality. Those ranchers are focusing on quality. That's what's really been driving the price up. Till we get to a point where that will break, and it will break. This is every commodity out there goes through cycles. This is the bull cycle when it comes to cattle right now, across the board. You also have the fear about H5N1 or whatever. There was a fear about that actually dropping weights. That's to the contrary. It's actually probably benefiting to the upside when it comes to weights. So I think you just follow that trend line for live cattle. It's just coming to a structural downturn right now when you're looking at price. Last two things. We have holidays coming up. So major drivers when it comes to demand, production also falls off. Okay, so we will have a massive production drop right before Thanksgiving, right after Thanksgiving, right before Christmas, right after Christmas. So you can look at the USDA; they have their own production weight charts. They have production. They have slaughter weights. They have all of it. You can check it on the USDA. Really good resource. But you'll see this massive drop off, and that's just because of the holiday. That massive drop off when it comes to slaughter, with an increase of demand that's happening right now, should tighten up supply, which should actually provide stability for prices. And then you got to worry about that December contract falling off, and then once again, kind of that re-rating going into next year here. So I think the price action is justified, and until it breaks that wedge that it's been in for damn near a year.
Yeah, it's been a long time.
You keep on trading those ranges. Oh, right, I'm sorry. Real quick.
Go ahead.
The correlation between soybeans, you're right? So like increase of production, a lot more cattle that's out there. You're going to need more soybeans, vice versa, and all of that. But the corn side of it is corn is used for feed. If you're looking at the quality of grain, though, soybeans destroys corn.
Oh, easily.
Hand over fist when it comes to nutrition. So knowing that we have both of those prices basically collapsing, I would suspect that you probably would have more soybean demand when it comes, or soybean meal and demand when it comes to that meal for livestock right now, probably rather than corn, just because they're pretty much trading. I don't want to say they're trading at parity, but nutritional value added to the prices that they're trading at right now, I would say most physical buyers are probably going to look at the bean market rather than corn right now. But corn also has the other side of the ethanol side of the equation too, right? So
it's the correlation just works very well for either one. So for me, I never really like dice it up too much. It's just, hey, this correlation is really good. Something to always pay attention to. But if I am looking at it, it is always going to be soybean meal is always the top of the list.
The meal is real, is how
the meal is real, dude. The meal is real. We'll end it there. Great parting notes to end on. Guys, the meal is real. Remember that. Take that home with you. And come in next week and be ready to hear Sam's full story on what that's exactly about.
Can't wait to tell it.
Oh, it's going to be great. It's all right, guys. Thanks for joining us. Make sure to follow our guys. We got KG out here, KG Bull and Bear on Twitter. We got Sam Gatlin. Sam and I write for the Gold Rush for All-Star Charts. And myself, I'm Jason Pers. I have my Substack, which is Against All Odds Research. Please give it a subscribe. We put out a lot of research and and if you guys buy the product, it helps to fund videos like this and keeps things like this going and keeps it free for everybody else. All right, guys. Hope you guys had a good one.